Perfect.
Thank you.
So just before we start, I wanted to acknowledge our sponsors, some of which have staff members who are participating in today's panel. So we appreciate all of the sponsors for our first annual, hopefully, Nevada Housing Summit. And I want to just welcome you to the Let's Build It panel. We have a great panel of experts that are here to speak with us today. You can see we have a very full panel. We have Roy Faerber and Mike Hemmens, who are going to talk with us today about the current and near-term state of the equity and debt markets, as well as the impact of changes in those markets on the availability of financing for tax credit funded and other affordable housing development. And we have Michael Holliday from the Nevada Housing Division and David Paull from Nevada Hand and Claudia Hansen from the City of Reno, who are going to provide some information on several exciting new tools within our state to help move more affordable housing projects forward. And then Eric Cicourel from the FHLBank of San Francisco, who's going to provide an overview of some recent changes to the bank's affordable housing program to better meet identified housing needs across the bank service territory of Nevada, Arizona, and California. So just kind of as setting a little bit of background and context, I think most of the folks on this session know that even before the pandemic hit, there was a need for more affordable housing in our state. And unfortunately, that need has grown over the past months due to the pandemic and impacts on our economy. So this is going to be a very timely and important discussion as we seek ways to continue within our state towards an equitable recovery and have adequate housing for everyone in our community using all of the tools that are available to us. On an annual basis, most folks may know that on an annual basis, the majority of income restricted housing units that are either built or preserved within our state are done so using two main programs, the 9% low-income housing tax credit program, which is a competitive program, and the tax-exempt bond program, which those projects are often paired with a non-competitive 4% low-income housing tax credit. On an annual basis, Nevada receives about $6.5 to $8.5 million in 9% low-income housing tax credit, or LIHTC, authority from the federal government, which is allocated on a competitive basis and then sold to from successful projects to investors to leverage enough funds to help preserve or build about 400 to 500 units statewide on an annual basis. The bond program is much larger and therefore allows the state to support larger projects. In the past several years, we've been fortunate to have kind of a resurgence of bond projects in our state to help preserve housing as well as construct new units. And in the past 3 years, the Nevada Housing Division has awarded over $540 million in bond financing to support the preservation or new construction of 4,433 units. So that's the good news. And, as I mentioned, we know that there's still a need for more affordable housing to be built in our state. And I'm looking forward to hearing from our presenters today to hear about ways that we could use some of the new tools to help kind of bolster and build more or preserve more units for the residents of Nevada. So with that, I will introduce our first speaker. And the way we're going to kind of run this session is we figured we'd spend some time talking about the state of the equity and the debt market, with our speakers and then pause to take some questions. Oh, sorry, Christine, I see I forgot about the polling. So back up, and we're going to start with a couple of polling questions. So if you could get out your cell phones and then use your cell phone camera to scan the QR code that's in the right-hand corner, and you should be able to then bring up Slido and submit your answer to us.
We have 74 people, so.
Oh, I'm sorry, Christine.
Yeah, we have 74 people here in the session, so hopefully we can get a good turnout.
Perfect.
It's just really for the panelists to help them know who they're speaking to. I'm going to give it 10 more seconds. You can also drop your name and organization in the chat if you're just not feeling the QR code today. There is a little bit of a challenge between me and one of the other tech people. Not that I'm techie, but so make me look good. All right, 3, 2, 1. And this next question helps set really the understanding of the group. I'll let you tee that up for us.
Perfect. So in 1 or 2 words only, please name the most important challenge relative to affordable housing production that Nevada must address.
If you have your phone still open, it should be really easy to put in there.
It should come up right away on your phone if you still have it open. If not, if you could just rescan the QR code, then it should come up with the new question and allow you to just type in 1 or 2 words to just kind of sum up what you think are the most important challenges relative to affordable housing production in Nevada. And it looks like we've had about 35 folks respond. We'll give it another few moments. I see Christine's putting up her hand to start doing the countdown. So I could do the countdown. So we'll 5, 4, 3, 2, 1. So it's interesting, funding, I've seen that come up time and time again in the sessions that I've been in. Also things to do with accessibility, supply, costs. So a lot of overlap between this and some of the results from other sessions that have taken place. So, well, hopefully we could hit on some new tools to address some of those concerns, as well as get a better understanding of kind of what's going on in the debt and equity market and how those changes might impact projects in Nevada. And so with that, I'll go ahead and introduce our first speaker. Roy Faerber is the Senior Vice President at Boston Financial Investment Management. He leads their Western US Equity Production Group, originating, structuring, negotiating, and closing affordable housing investments. He has specialized in affordable multifamily housing for 20 years and invested over $2 billion in LIHTC equity. He is based in Los Angeles and is a frequent speaker at state and national conferences. And we're very happy that he's able to join us today and share his perspective.
So thank you, Hilary. Really appreciate you. That was a very nice introduction. Like she said, my name is Roy Faerber. I'm with Boston Financial. We are a tax credit syndication firm. We buy tax credits in low-income housing transactions. And we've been doing it, we've been investing in affordable housing now for just over 50 years. We just had our 50th anniversary. I've been doing it for 20 years. And like Hilary said, I'm based in Los Angeles. I'm going to keep my remarks fairly brief. I'm sure people are going to have questions, but I want to at least give everyone a market overview so you can understand what's going on in the tax credit market currently and what we think will happen going forward. First, I want to rewind. In 2019, we had a very healthy tax credit market. And going into 2020, we were looking great. Interest rates were low, tax credit pricing was high, investor demand was high. Things were humming along very nicely. And then, like everything else, when the pandemic hit, we had to slow down, we had to digest what was happening, and we had to deal with potential repercussions. Fortunately, we were deemed as a group, our whole industry was deemed an essential service. So we were able to continue with construction, with closing, with allocating. People were able to work remotely. We've sort of settled in and figured it out. But where we've ended up, unfortunately, is that there's a little bit less investor demand. As a result of the pandemic, investors, some very big ones have pulled out of the market, and some big ones have shrunken their demand for credits. And that's partially due to economic reasons. They don't know, if they're going to have as much taxable income going forward. Partially due just to fear of the pandemic. So it's been a little bit bumpy, I would say, compared to where we were in 2019. Overall, and we have added some investors as well, and some of the existing investors that are in the business have actually increased their appetite. So, but I'd say net overall, we're definitely, we have a lower tax credit demand as opposed to supply. So supply definitely outstrips demand currently, which, as you can imagine, that creates some downward pressure on pricing. There's also a couple other factors that are impacting the supply and demand structure with tax credits in the market. First, because we have such a low interest rate environment, which, don't get me wrong, it's fantastic, and Mike Hemmens with Citibank will go into that in a few minutes. That's allowing bond deals to pencil that 1, 2, 3 years ago weren't able to pencil because interest rates are so low. You can size more permanent debt and make your deal work. But what that does, unfortunately, with regard to the tax credit market, is it brings a lot more credits into the market because there's just more deals, right? So that's creating even more supply that we didn't have necessarily, a year ago. And then secondly, there's a one-time event which is causing some short-term supply and demand imbalance, further exacerbating the problem, and that's the state of California just allocated an additional $1 billion with a B, worth of 9% credits 2 weeks ago. The federal government allocated those credits specifically, in addition to California's normal allocation of 9% credits, they allocated them to the state of California to help with rebuilding from the wildfires that the state has been suffering. So you look at the supply and demand imbalance that I'm talking about. You have more bond deals with more 4% credits, an extra $1 billion of 9% credits, and you're already trying to overcome some investor scarcity. So what does this mean, right? What does this mean to us as an industry? Essentially, investors are being just a little more selective in the deals they are choosing. If there's more deals than investors, right, there's more opportunity to look at multiple deals. They're going to pick the ones that they deem best. So there's a little bit of a flight to safety. They're prioritizing deals with lower risk, deals with more experienced sponsors, and deals with stronger guarantors in light of the pandemic and some of the economic uncertainty that could befall a property once it's built. Also, heavily levered deals that have a lot of hard debt, 60, 70% hard debt in relation to the total capital stack. They're not as in demand as they've been in the past, and they might not get the pricing that they would have gotten in the past, further exacerbating a sources and uses problem for a deal like that. And lastly, acquisition rehabs are sort of the least in demand out of all deals. You have, I would say, 9% deals, then new construction bond deals, and then lastly, acquisition rehabs And that's just because a combination of a number of factors. It's a bond deal. Generally, it's heavily levered with a lot of permanent debt. So there's presumed risk by the investor community, and it's an older deal as opposed to a brand new piece of real estate. And also they deliver a lot of losses, so it's not as appealing to investors with that structure. I can answer more questions specifically why about acquisition rehabs if folks have questions, but just generally speaking, they are not as attractive currently in this market. So what's the good news, you say? It's all bad news. Now, I've got some good news. With everything I've just laid out, the market is still functioning well. Deals are getting done. Pricing is a little lower, as expected. Supply and demand problems. Pricing is going to cause downward pressure on pricing, but deals are closing. Terms are a little more conservative, a little more favorable to the investor. They might want larger reserves, a little bit more vacancy underwriting, things like that. But we're getting deals done. We have Boston Financial. We have several active proprietary investors that we're closing deals with right now. We're also closing our second multi-fund, our multi-investor fund this year. We're going to do pretty much the same amount of equity we did last year. We're going to do another $800 million worth of equity. So, it's hard to say that things are worse, but the pandemic is definitely causing some stress in the market, and some of the economic uncertainty that comes out of the pandemic is causing some stress as well. There's some additional thoughts I want to share with the group. One is tax reform. If we do have tax reform next year, and depending on what happens with the upcoming election, there may be changes in the tax code that impacts tax credit pricing. It could also impact the number of credits that are available. Let me tell you two things as examples. Number one, tax credit pricing could be affected by a higher corporate tax rate. If you recall, we used to have a 35% corporate tax rate, and that got reduced to 21% in 2017. Well, if that goes back up to 28%, which is what Vice President Biden is proposing, if that goes through Congress that way, that would conceivably increase tax credit pricing, which would be great. Second thing that could impact tax credit supply, and that's if they fix the 4% tax credit rate at 4%. As many of you know, the 9% rate is fixed at 9%, and the 4% rate still floats. They fix the 4% rate at a real 4%, a true 4%, that will generate more credits for every dollar that you spend in a bond deal. All of those additional credits, while fantastic, right? It would be great for the market to get more deals done. Unfortunately, that will create downward pressure on tax credit pricing because now you have a whole flood, 30 to 40% more credits coming into the market that weren't there previously. So again, supply and demand, what I was talking about earlier, that could very well create downward pressure on pricing. So those are things to watch with tax reform. And one last thing that's just jumping into my mind that I didn't even write down with tax reform is depreciation. We've been enjoying accelerated depreciation, bonus depreciation in the last 2 or 3 years. Expensing a large segment of the development costs in year one, that has helped tax credit pricing tremendously. Under Mr. Biden's plan, Vice President Biden's plan, he's proposing to take that away to help shore up some of the shortfalls in our budget. That wouldn't take away the depreciation. You would still get it. It would just be a little slower, which would slow down the losses that investors can take. Downward pressure on pricing. Hopefully I haven't bored all of you, but that's sort of the highlights of what tax reform could do. A couple other items I want to mention. COVID, please be prepared if you're working on a deal or if you're underwriting a deal, looking at a deal, if you're an agency or a soft lender. Ask the sponsor, and if you're the sponsor, be prepared to talk about COVID. How your GC, your management company, et cetera, are handling the pandemic. Is your current portfolio, are you having collection problems because of the pandemic? Are your construction jobs, are you having delays? Are you having trouble getting supplies? Materials, inspections, permit issuance, et cetera, that all can impact your transaction. So what we've been doing and working with our investors is gauging their appetite for risk and talking to developers about lengthening their construction period by a few months, 2 or 3 months, depending on what makes sense, to absorb any potential shocks or impacts from COVID. Something to keep in mind. Tools in the tool belt, the buzzwords. We suggest that everyone work to find ways to increase their sources and reduce their uses. Sounds simple, but the more you think about it, the more prepared you are, the better off you'll be if the unexpected happens. Sources such as soft debt and state credits that David and Eric are going to talk about, they can be invaluable. Uses like impact fees and permit fees, some of which Claudia is going to discuss, they can be reduced in many cases if you ask, and that can help make your project pencil or capitalize more cash fee and give you more cushion in case something unexpected happens during construction. Be thoughtful, be creative, and collaborative. In the end, we're all working together. It's a really great industry for this. We're all pulling the rope in the same direction to try and build as much affordable housing as we can. And it's a collaborative effort. So I suggest, work with your partners. If I can be a resource, I'm happy to answer questions of anyone. If you have a model that you want to show me, even if it's not ready for prime time, I'm happy to go through it, work through issues with you. And I think that goes for pretty much everyone in the industry on the investor and lending side. So with that, Hilary, I can turn it back over to you and be ready for questions later.
Perfect. That was a lot of good information, and we did have some questions come up. What I'm going to do is just have Mike Hemmens speak, and then we could go back through and just spend some time, a little bit of time answering the questions that come up based on both discussions. So with that, I'm going to turn the mic over to Mike Hemmens, who's the Managing Director for Citi Community Capital. Mike's been involved in many aspects of the structuring of affordable housing real estate financing, including providing permanent and construction loans, securing credit enhancement, conducting due diligence, performing financial analysis, and collaborating with sales and trading professionals to market securities. There is more in terms of all of our speakers in the bios that have been attached in the chat section. I'm just kind of, in essence, because of timing, I'm just trying to give you some highlights, but we're fortunate that Citi has participated in numerous bond projects and other projects in our state, and we're happy to have Mike here today talking with us. Thanks, Mike.
All right, I appreciate that. And for those of you that had the burning question as to what Roy's paying for LIHTC equity, he generally stays in that $1.10 to $1.15 range. So just a heads up there. Let's start off here. Let's hit the next slide, Christine. This just gives a general snapshot for what it is that we do. Citi Community Capital is primarily a balance sheet tax-exempt lender focusing on the 4% tax credit side of the business. We're on track to do another $6 billion of lending business in 2020. So it's been a busy year. This reflects last year. So probably about 15 to 20% more in volume in 2020 versus 2019. So it's been busy. We are primarily a balance sheet lender offering construction and permanent balance sheet loans for large 4% transactions. We also have a Fannie and Freddie Mac license, so we're very active in the Fannie Mae and Freddie Mac lending space. We also are a big holder in LIHTC equity. As Roy may have alluded to, Citi is not currently in the equity purchasing space, the LIHTC equity purchasing space, but we have a large portfolio of existing tax credits. We operate in most every state in the United States. I think there's a couple states that we haven't done business in. I think Alaska one of those states, but we've pretty much been active in every other state. We have offices throughout the country. We're traditionally just a volume shop. So let's hit the next slide, Christine. This kind of gives a general source and use of a typical 4% tax credit transaction in Nevada. As folks know, there are local and state subsidies that are needed to build larger projects, mostly on the 4% side. So this kind of gives a general overview for what a typical transaction might look like. Let's hit the next slide here. What causes perm loan amounts to go up or go down? It's generally rents, and so since 2014, we've seen some good rent increases in this state. We've actually seen that throughout the country. It's allowed transactions to balance with larger permanent loans, as Roy talked about. So you've seen some pretty nice rent increases since 2014. As folks know, it's sort of a lagging indicator. And so I think people are expecting another increase in 2021 and then probably flattening out or dropping a little bit. So let's hit the next slide, Christine. All right, this is so what else causes loan amounts to go up or down? It's rates, right? So rates are low. I mean, this is the 10-year Treasury. I think it closed at 77 basis points today. And so it's been hovering nice and low, which some people say is a good thing. I sort of think it's not a great thing. I think it's too low, and it probably causes some other issues out there. But 10-year Treasury has been low. I don't think people are projecting that it's going to dramatically go up anytime soon. So so we'll see what happens. But currently, the index is low. Next slide, Christine. All right. So what makes up your rate? It's the index plus it's a spread. And so we quote permanent loans off of a LIBOR swap index, and you'll see that back in 2019, you saw spreads were and I guess I'm focused on the post conversion, the permanent rates here. So you'll see here that. In 2018, I guess early 2019, spreads were at a pretty good spot. Actually, they were permanent loan spreads for us were kind of in the 200 to 250 range. We did see those drop. I guess at the end of 2019, first part of 2020, we did see a compression in spreads. COVID hit, like a lot of banks. We were. Everyone took a deep breath. The markets were going bonkers. People took a deep breath, and we adjusted spreads. And those spreads were probably about 100 basis points higher over what's shown here is the February 2020 spread. Spreads increased about 100 basis points. And they've come down a little bit, but they're still reasonably higher than they once were pre-COVID. We also saw the index has dropped, dramatically. So you're still getting really good interest rates, good long-term. These are forward rates. This would be a new construction forward commitment. And so why don't we hit the next slide here, Christine? All right. So what sort of goes into a project? And again, focusing on the new construction front. I'm a believer, and David would have to tell me if I'm wrong, but I'm a believer that costs are coming down. I don't think we've actually seen it yet, but the data here that we're getting from Turner Construction, I guess there's a construction source here, they are showing that costs are down. I don't know what goes into this, but my own belief is that costs have got to come down. There's going to be fewer hotels, fewer shopping centers that are built, fewer offices, I got to believe. And so, we are fortunate in the affordable multifamily space, and that we actually didn't see any of our construction jobs really shut down for a meaningful period of time. Some projects were stalled out for a tad bit while they were trying to figure out if they were essential or not. But generally speaking, our projects were not really affected. And that's coast to coast. Rehab projects were challenging, and developers were able to make some modifications to keep those projects going. But we're super fortunate in this space. Let's hit the next slide here. So just sort of some things that we think about, and it's enabled us to keep lending in this environment. We are active, as Roy noted. Everyone's focused really on project specifics, developer specifics, and so you will hear that banks are a little bit pickier and careful and thoughtful, and we get a lot of scrutiny internally all the way up the credit bank chain. And so there's a tremendous amount of pressure on groups like us within Citi, other groups that operate in the affordable housing space within their banks, tremendous scrutiny. So we are definitely pickier, but some of the things that insulate the tax credit projects are the things listed here: operating reserves, tax abatements, valuable tax credit streams. That we take a lot of faith in the equity investor there with those streams of credits. Vacancy rates have continued to stay low. Discount to market is still pretty healthy. But there's things that I don't know how it's going to really affect us here. Unemployment, eviction moratorium. Some of the things that have helped is I've been hearing more about voucher subsidies coming into projects that frankly didn't exist before. And so it does feel like the whole United States is really out there protecting these projects and the tenants that are really most at risk. So I think that's a fantastic thing. I think that's it. Christine, can you hit the next slide? Yep. That's it for me. So again, Roy's offering $1.10 equity pricing. So give him a call if you want that. It's limited supply. So quick on the call, okay?
And Mike, and just so everyone knows, Mike is our investor. So Citibank will fund it.
And they'll both be putting their numbers in the chat box, right? We did have a couple of questions that come up, and thank you. It was very informative, both of your presentations. We did have a couple of questions that came up in the chat. One question is whether there's more appetite from investors for one particular product type, such as senior housing versus family housing, or if there's more particular interest in some regions than in other regions.
Yeah, I would say regionally, investors are motivated by CRA demand, which stands for Community Reinvestment Act. So to the extent there's deals located in larger cities or counties that contain larger cities, those deals will get better pricing overall, because investors need to reinvest in the banks need to reinvest in the markets that they are banking in. So if there's a bank XYZ has very large deposits in Las Vegas, then the entire Clark County area will be in their CRA, and they will pay more for those credits than a deal in out in a more rural area. And then I guess the second part of your question was family versus senior. There's not a huge preference either way. That could be investor by investor. Mission-driven people might be looking for, special needs, homeless housing versus regular general occupancy, but that might also turn an investor off. They don't like that profile. So I wouldn't say there's anything hard and fast with regard to one preference or another. I will say, though, that senior deals are generally underwritten a little more flexibility. They generally are looked at to be have lower turnover. So there will be lower costs for operations per unit. And also vacancy, investors will look to a 5% vacancy as opposed to on a family deal, they tend to go to a 7% vacancy.
And I would just add too that it's interesting. We've seen we probably have about 10 age-restricted projects on the West Coast that have come online the last 4 or 5 months, and the interior hallway age-restricted properties, historically have leased up, call it 20, 30 units a month. That lease up right now during this period of time is like 1 to 2 units a month. And so tremendous amount of pressure to get those types of projects leased up. It's looking like it's the interior closed hallway. Those projects are struggling. Obviously, I think everyone hopes and believes that, this is just a moment of time, and hopefully by next summer, we're able to look at life a little bit differently. But that is an interesting thing that I don't think anyone saw coming. And like I said, we have about 10 right now that we have active construction loans on that just are not able to lease up.
Great. And then as others have questions or comments, please type them into the chat box, and then we'll go ahead and get those answered. I know that there's been a little bit of discussion in the chat about which index you think will replace the LIBOR going forward. So I don't know if you could just spend one moment talking about that, and then we'll continue on, just that we have enough time for the remaining part of our session.
So I can chime in. Yeah, so it does. I think someone responded that SOFR looks like it's the it's the replacement index that folks are using. I don't know if Citi's made a formal announcement yet, so I can't tell you what we're going to do. But it does. I know Fannie and Freddie have made the announcement. Other lenders have made that announcement. It does appear that SOFR is the overriding replacement index.
Thank you. Well, thank you both. And I know that you'll be available throughout the session. So again, as others have questions, we have more time allocated at the end and could hit on more questions as well. Sorry about that. In the meantime, we're going to transition to our next portion of the session. And the first speaker that I'd like to introduce is Michael Holliday, who is the Chief Financial Officer for the Nevada Housing Division. Michael has nearly 30 years of accounting and finance experience in the private and public sectors. He's overseen the issuance of over $857 million in multifamily housing finance and $100 million in single-family tax-exempt financing in just over 6 years as CFO with the Nevada Housing Division. Additional information on Michael's experience could be found again in the bios in the chat section. And with that, welcome, Michael, and we look forward to hearing your presentation.
Thank you for that introduction, Hilary. So I've heard good news already today that we're getting $1.10 tax credit pricing and that permanent rates are going to be 2.78%, 2 7/8 going forward, right? All right. Just kidding, giving Mike and Roy a hard time there. But no, in all honesty, it's my pleasure. I want to thank the Nevada Housing Coalition for having us to come speak about the newest tool we have in the toolbox, the Nevada Low Income Housing Tax Credit. Which is the first new tool we've actually had at the division since 2014. We had a program the division created called the Growing Affordable Housing Program, which was a soft debt program. And this that was part of the conversation that started us headed down the housing tax credit route. So Christine, if I could get the next slide, I'll give you a little history of how this came about. So in the 2017 legislative session, there was a Senate concurrent resolution, SCR1, that created a committee to study issues regarding affordable housing. And that committee was made up of stakeholders from a lot of different aspects of the industry. So we had legislators, we had developers, we had housing advocacy groups, we had consultants, we had tax credit experts, and we had division staff. And it was great. There was a lot of great discussion. And I think that from the get-go, the the committee was led by Senator Ratty, State Senator Ratty. He did a great job of saying, let's not rehash the issues because there are a lot of studies saying what the issues are. Let's work on solutions. We have limited time, so let's come up with some solutions. One of which, and it was recommendation number 5 from that committee, was to come up with a new tool for helping to finance affordable housing. And a lot of ideas were floated. The one that actually everyone felt like had the best chance of success and actually would be the most useful would be a state low-income housing tax credit. What's interesting about that in Nevada is that we don't have state income tax. So it was not maybe going to be the same structure that you would see in other states that do have that. Through the 2019 session, though, we found there was strong support from not only the governor's office, but also from the legislative body. And Senate Bill 448, SB 448, in that 2019 session passed unanimously. And so what that did was create a Nevada Revised Statute 360.860 through 360.870, basically created a brand new Nevada low-income housing tax credit. The next slide, please. So why did that committee come up and say that we needed a tool to create more affordable housing in the state? What we have here is, and this is similar to something that Mike showed in one of his slides, is a kind of a typical financing structure. And this is from an actual project here in Nevada. And you can see all the different colors or the layers in the capital stack, which our administrator affectionately refers to as lasagna financing. And those are the layers of lasagna, there. Well, the one in red that sticks out at the top is what we consider the financing gap. And on a project this size, which was 201 units, $34 million total project cost, after we squeezed everything we could out of all the other layers of financing, there was still a gap of about $3 million. And up until 2014, there wasn't really a tool to address that gap, and we didn't have many, if any, new construction tax-exempt bond 4% tax credit deals because that gap was still there. In 2014, the division came up with its soft debt financing gap program, and we started to get these deals to happen again. Because we have limited resources as well, that's limited to two a year, roughly 400 to 500 new units a year. And what the SCR1 committee said is, well, if we could come up with another source, maybe we could do 2 or 3 more projects a year in addition to what we were already doing to create another 600 units on top of that. So the tax credit was designed to fill that $3 million financing gap at the top of the capital structure. So Christine, if you could move to the next slide. So what is it? Now we know why we needed it. So what the legislature approved was up to $10 million a year in state tax credits as a pilot project for 4 years. So meaning we could do a total of $40 million over that 4-year period. These are transferable tax credits. Well, what does that mean? Well, that means that when we have a project that applies for tax credits, and I think David's going to talk about one of those, state tax credits, we're going to issue the certificate to the developer, to the project. The developer can then transfer that certificate, and we've been using the term as like you would get a gift certificate from someone. Well, you can hand the gift certificate off to somebody else, and they can go buy a meal with the gift certificate or whatever it may be. Well, this is going to work the same way. That certificate can be transferred to someone who finds value in what the tax credit is. So what that is, there are 3 taxes that the tax credit can be used against: gaming license fees, business tax, the modified business tax in the state, and insurance tax. Because Nevada doesn't have a state income tax, we had to find a combination of other taxes that might make this widely marketable. And those, based on discussions with the revenue folks and taxation, were the most popular taxes that seem to generate the most potential appetite for these tax credits. And they had been used previously for Tesla tax credits and film tax credits as well. So once that certificate is issued to the developer, it's good for 4 years. So basically the holder of the certificate has 4 years to use it against a tax. Now, the one thing that is nuanced is that the tax has to be declared when the certificate is delivered. So that at that point, the developer would have to say, or whoever they're going to sell them to, we're going to use it against business tax. Well, then they have 4 years to use it against business tax. They don't have to use it all at once. So we tried to keep that legislation as simple as possible. It really leverages the federal low-income housing tax credits, which everyone was already familiar with. We didn't create a lot of extra rules on top of that. So we hope that as we move forward with it, it's going to be pretty streamlined. So that's kind of an overview of what it is. And Christine, if we go to the next slide, this is kind of how it works. So the little graph on the left-hand side. So the division awards the tax credits to a developer or a project. It is going to be for a specific project. It's going to be owned by a developer typically. The developer then could either use those tax credits. We don't think that's going to be the typical way they're going to use. More often than not, we think it's going to mimic federal low-income housing tax credits, where they're going to sell those to a private sector investor. So in return, the private sector investor gets to take a tax credit against one of those 3 taxes over the next 4 years. They're going to give cash to the project, meaning the project has to borrow less money then, which is going to help to lower their operating costs and to keep the rents low and be able to be a successful project over years. So in my mind, this is, again, much like the federal low-income housing tax credit program, a great example of a public-private partnership. So in this case, a development receives cash in the form of equity, and that helps them to borrow less. They can keep the rents low, and they have less strain on operations going forward. The investor, who's a private sector, uses the tax credits to help their cash flow by reducing their tax liability to the state, so they find some value in it. The state itself, and not the housing division, the state itself actually was able to provide then a resource to create more affordable housing by foregoing its future tax receipts. So, they're giving up these taxes when the credits come in, they just don't receive the tax for those. And so basically it was a way for the private sector then to step in and to provide yet more affordable housing options for Nevada residents. COVID hit and we were allowed to start issuing these on January 1st of this year. And we had a couple projects that were somewhat interested. And then when COVID hit, as been discussed by both Mike and Roy, a lot of market uncertainty, so we weren't sure about the value of these. What we had been told is that typically in the past, the existing state tax credits of various kinds have been purchased by gaming companies. Well, as we all know, they've taken a huge hit during the pandemic and the shutdown. So we now think that it may be different than what we initially thought, that it may not be gaming companies. We may actually partner with some of our more standard tax credit partners to make this work. That, in a nutshell, is the new tool we have, and it could move the needle. I mean, we could get another 600 units a year of affordable housing, which would double what we're able to do right now. So I think it was a huge win. It was a big push by all the parties involved. We had a ton of support, and be glad to answer any questions about it as we move forward.
Great. Thank you, Michael. And then, as you mentioned, we're going to hear next from David Paull at Nevada Hand. And David is the Senior Vice President of Real Estate Development at Nevada Hand. And Nevada Hand is a nonprofit affordable housing provider that's been providing affordable housing and supportive services to working families and seniors on fixed incomes for over 27 years. David has more than 18 years experience in real estate acquisitions, development, and asset management. And since joining Nevada Hand in 2011, he's overseen the development of 18 new affordable housing communities, totaling over $300 million. We're really pleased to have David here today, and he's going to talk with us about a project that they're undertaking that's utilizing the state low-income housing tax credit that Michael just talked to us about.
All right, well, thank you, Hilary, and thank you to the Housing Coalition for having me here. We, like Hilary said, we've been developing for over 27 years and have developed over 5,000 units now, and this is probably the development we're most excited about. I do say that about every new development that we build, but this particular one is using the new state housing tax credit, which with the onset of COVID, we thought was going to really just disappear and not be useful. So what you see before you is our Decatur and Alta development. You're seeing the senior portion here. This is a 420 unit tax exempt bond development that leverages state housing tax credits to make it possible. We are partnered with George Jakakis, who is a longtime affordable housing developer here in Southern Nevada and has been developing almost as long as Nevada Hand. You can go to the next slide here. So this is an infill development of a former car dealership that has been vacant for 10 plus years, longer than I've lived in Southern Nevada. So we're really excited to put it to good use for affordable housing. So we're developing 420 units. 240 of them are family units and 180 of them are senior units, which this is one of the largest affordable housing developments in quite a long time. Michael might be able to tell you how long, but I think at least 15 years. And so we're very, very excited about it. And I think we're most proud of the 36 units at 30% of AMI that the state tax credits help us leverage. It's not typical to have that many units at 30% of area median income in these developments. They don't pencil. We don't have a lot of subsidy in Nevada. So getting those state tax credits has allowed us to provide a lot more units. And as everyone or many of you may know, Nevada is one of the worst in the nation at providing 30% units for our population. So we're very, very proud of that. I said the 420 units is significantly more than you would typically do in a tax-exempt bond transaction. You are typically doing between 150 and 200 units, and Michael showed the slide with the $3 million gap there. With the state tax credits, we were able to leverage significantly more units, and so we're really, really excited about that. And we think this first project will drum up a lot of enthusiasm for the state tax credit, and make it a very successful new source of funding for us. We actually expect to close our financing on November 12th for this development, and construction will be completed in early 2022. Go to the next slide, please. So you can see our project cost here is almost $90 million for this development. It's quite a significant undertaking. I'm probably going to lose the rest of my hair from it, but it will be great for the residents of Southern Nevada. You can see the tax credit equity here, which is being provided by Wells Fargo. The tax exempt bonds are being bought by Citi. And let me just say that Citi has invested at least $300 million in the last 10 years with Nevada Hand in debt, and we're really grateful for that. They've been a tremendous partner for us for a very long time. The state of Nevada is providing $3.6 million in housing trust funds, as well as $3 million in state tax credits, as well as a $3 million gap loan that Michael talked about as a new source of funding back in 2014. Clark County is providing $1.7 million in home funds. City of Las Vegas is providing another $1 million, and then we are deferring $6 million in developer fee. So it's a rather large capital stack with a number of moving parts, which adds to the complexity. But it's part of the lasagna financing and how you get this done. I think this is not what you're going to see typically going forward. You probably will see more developments in the 200 to 300 unit range. That would be my expectation. I think we hit this just right for a number of our funding sources. Our tax credit pricing is higher than what the market is right now. We were able to lock that in. Actually, I think days before the state of Nevada shut down, and many other places as well. So we're very lucky there. We were able to lock in our spreads for our lending financing right before that happened as well, before the debt markets just went haywire. So some of this may be just a little luck that we were able to put all of this together. Go on to the next slide there. So with the $3 million in state tax credits, we're leveraging $86 million in additional funding, or said another way, $1 for every $29 of additional funding. I mean, that's a really small investment to leverage what is a large amount of funds. And as far as a new source of funding, you probably couldn't ask for something better for really maximizing taxpayer dollars, which is what we all want to do, and do it in the most efficient way possible. As the first awardee of first recipient of this award, it's great to be first, except that when you're first, there's no real systems in place. There's no templates. So we're working through a number of questions with the investors and Nevada Housing Division and the Office of the Attorney General to answer all of our investor questions. And some of those questions range from, is there an application for selecting what tax you are going to take the credit against, to if the tax credit certificate is issued in December of a given year, does that count as one of the 4 years you can use the credits in? So I guess it's fun being a trailblazer, but there's a lot of issues and questions that have to be answered. So anybody coming behind us, hopefully we've done a good job in setting this up for everyone else. Like I said, we're very, very excited about this and think this fills a huge need in Southern Nevada, and hope that others are able to replicate something close to this in the future. So with that, I'll open it up to Hilary if anybody has questions.
Thanks. Yeah. So it sounds great and very exciting. And I do want to mention too that the state tax credit will be up for extension in the upcoming legislative session. And so I think that there'll be more discussed about that during tomorrow's member session. Is that correct, Christine? But definitely, as you can see, it makes a huge difference in the ability to do these kinds of projects, and would just appreciate everyone's support as that makes its way back through the legislature. We do have a couple of questions that have come up in the chat box. I don't know if our speakers could look at those, and we'll continue with our panelists and then come back to questions at the end. Our next panelist is Eric Cicourel, who's the Managing Director of Community Investment at the Federal Home Loan Bank of San Francisco. And Eric has worked in the Community Investment Department at the Federal Home Loan Bank since 1999. He manages the Competitive Affordable Housing Program, or AHP Program, and is integrally involved in all aspects of the program, including policy development, scoring, project financial feasibility analysis, and technical and administrative operations. He also manages the operational aspects of the Community Investment Cash Fund credit programs, and is vice chairperson for the bank's Quality Jobs Fund's Donor Advisory Council. And David and I have the pleasure of serving on the bank's Affordable Housing Advisory Committee, and we are very appreciative of the bank's investment in this summit, as well as other investments that the bank has made in projects within Nevada. So with that, I will turn it over to Eric so that he could begin his presentation.
Hello, good afternoon. I hope everyone can hear me. Just a quick thumbs up, that would be good. David, Paul, I can see you if you thumbs up. Yeah, good, thank you, Mike. First, thank you to the Nevada Housing Coalition and Christine Hess in particular. It's a heavy lift to do all this, and it's been done quite well indeed. I'm enjoying myself. And also Hilary for moderating. Given my allotted time, this is going to be a bit of a helicopter ride. So hang on to your seats, stools, kitchen counter, whatever you got, and we'll move forward through this. Next slide, please. Okay, if you attended the last session, you heard my colleague Iris Tam Bailey go over a bit over the history. I'll try to make it brief and have a little different spin. So the creation of the Federal Home Loan Bank system is connected to the history of affordable housing in the US starting in the 1930s. The goal was to stimulate the economy through new entities, Federal Home Loan Banks, the FHA, Fannie Mae, and this created a structure of public housing. We have the same regulator as Fannie Mae and Freddie Mac, and that's the Federal Housing Finance Agency, or the FHFA, and comprehensive legislation in 1989 to reform the financial industry in the wake of the savings and loan crisis was how the AHP largely came about. So the AHP was created by Congress in 1989 and began operating in 1990. The AHP is so popular, we have our very own examination team that focuses just on the AHP, and they visit us annually. With almost all the community investment programs and products, we partner with our members, and customer service is a real important aspect of the work we do. But I would say for most people here, the next item is the 10% of the bank's net earnings going to the AHP. So when the bank performs well, our program has more funding. Straightforward, simple formula. Next slide, please. You might have seen this floral arrangement in the last session as well. The bank never loses sight of its public service mission and of the fact that through the community investment programs, the bank can help members form valuable connections with their communities. And the outer ring clearly depicts the interconnection between our members and community partners, which is important. And the diagram also represents most, if not all, the programs, products, and activities that the team at the Community Investment Department is directly involved in. And these programs and activities are all intertwined and connected really to improve the lives of individuals, families, and communities. Now, I'm not going into the details of all these programs. I'm going to be focused on the upper left side there at about 11 o'clock. That's the AHP competitive. And that's what I'll be focused on the next slides or so. So next slide, please. Basic contribution to the AHP. The 10% of net earnings is split between the WISH and IDEA down payment assistance programs and the competitive AHP. And on the slide, you'll see the breakdown of this year's spring competitive round, which was based off of the bank's earnings from 2019. We add in 9.3 million from funds that weren't used or returned. And as you can see, we had roughly 37.7 million available for 2020, which was a sizable amount. Next slide, please. This is a little bit more detail in the competitive program. I'll just highlight some points here. The AHP funds the development of different types of affordable housing, from multifamily rental housing to transitional housing to single family homeownership. The program is structured in a way that the rental and homeownership projects apply and compete together, meaning that there's no specific set aside for either project type. One competition held in the spring, usually a March application deadline by the first week. And the key here is members and sponsors apply together on a project and are partners throughout the lifetime of the year. The timeline at the bottom is showing really the life cycle of the project, or at least the AHP project. You have 4 years complete once you receive it. There's a 5 and a 15-year retention period that's noted at the bottom. And I won't go into detail of those phases. The monitoring is really the favorite of everyone, so but I won't discuss that. Next slide, please. Okay, so highlights of the program changes effective 2021. So the scoring related changes reflected here represent, except for the last bubble, scoring category revisions related to the adoption of the new regulation that was published in November of 2018. And other changes that we believe will enhance the effectiveness of the program. So the new regulation, it had a lot of intentions, but one of the main things was to really modernize the AHP. It hadn't been done for a while, and provide more flexibility for the banks to run their programs, and a lot based on what the district needs were. So that I have to say, that being said, although we have a bit more flexibility, the bulk of what that can be done is required by statute. So as a result, we have limited flexibility within that flexibility. And in developing some of these changes, the bank used the results from extensive market research, including a survey that we put out to nonprofit organizations, housing associates, members, you name it, and that work was conducted for our targeted community lending plan, and it really assessed and identified the significant affordable housing needs in our district. And so out of that, one particular item came up, and that was housing for households requiring large units, or for families in general. And so we created a 3-point category, and the new regulation allowed for that. And we believe that this should really help some of the Nevada projects be competitive. And I'd also, just a little plug here, planned that your Nevada Housing or your Nevada Affordable Housing Advisory Council members, David and Hilary, were directly involved in working with the Community Investment Department in crafting this new category, as well as discussing the other changes that we made. Project readiness. Currently, to receive points for zoning, project sponsors must have a local planning official sign a bank form certifying that the project has already received any required zoning approvals. So removing this scoring element, in our opinion, should streamline without compromising the bank's scoring review process and simplify the application process for project sponsors. So I think I would imagine as a project sponsor, I'd be happy with a streamlined process. In terms of the promotion of empowerment, the key element here is probably removing the on-site services requirement. And I think that will be assisting the Nevada projects as well. I think a lot of projects are very tuned in terms of getting that good services that are not necessarily on site. And I think it's a bit more restrictive when you have it on site, although those are obviously more than adequate. In terms of the subsidy per unit, that change I'm happy about, because it's been a long time coming. Because up to now, the scoring criterion generally favored more highly leveraged projects and other large rental projects, where the HP award is a smaller percentage of the total project development budget. And with this change, the bank was trying to encourage HP awards to owner-occupied projects and smaller rental projects that may not be able to leverage as much funding from other sources, and therefore need a deeper subsidy from the AHP. And lastly, but not least, is sort of a significant change, is the AHP competitive program will now be called the AHP General Fund. So going forward, as of in 2021, we will be referring it as the AHP General Fund. And I'm highlighting the low-income tax credit monitoring comments because, frankly, I almost think that's one of my favorite part of the new regulation, which we adopted early, because I think removing the income documentation requirement for the low-income tax credit projects really, removes a burden of program participants having to provide this information to multiple parties. And although the bank adopted this change early, as I indicated in 2019, it's an important change that warrants attention and might not be completely known by all our project sponsors out there. Next slide. Okay, so how to stand out from the crowd, and that was my homage to COVID, as well as how you can score well. So here you're looking at, homeless and special needs stand out prominently, and providing housing for these populations really just makes your project competitive. And you can see from the results from the last round, pretty high percentages of projects that were approved. And they were higher percentages than in 2019. So if you basically, this slide is saying if you do well in these first four categories, your project has a pretty good chance of being competitive for an award. As for targeting and empowerment and subsidy per unit, I'm calling these out as well, because most approved projects receive full points in them. And if you don't receive, at least in sort of targeting closer to the full points, you are really going to be at a disadvantage, or just going to have to pick up points elsewhere. Other difference makers in terms of categories: rural housing and donated property. And I don't mention these lightly as if it's easy to obtain donated property or to develop a rural-based project. It's just the fact that they can help if you're not touching sort of special needs or homeless. Next slide, please. Okay, Nevada's experience here in the 2020 AHP competition. So I will just say that this was a banner year for Nevada projects. Not only were 4 of the 8 submitted projects approved, of the remaining 4 not approved projects, permit ready, if they're permit ready, they would have potentially brought those projects into the money. And that's a pretty amazing feat this year, I'd say. What were the scoring characteristics of these awardees? Well, linking my comments from the last slide, these 4 projects received full points in targeting, empowerment, and subsidy per unit, as you can see from the matrix there. And you can see how well they performed in the other key categories as well. So if you note project number 3, no homeless points, but it was able to claim full points for building housing in a rural area. And so that was a key, I think, to that project receiving an award. And the asterisks that are there, if you can see them, are really the why these projects were competitive. It was not always about full points, but that certainly would have helped. And I'd say those are my comments there. I want to just really conclude the presentation, because I'm running out of time here, or I probably already did, is to share a few words in the name of collaboration, which is what the summit is all about. And I say, as the bank and our Affordable Housing Advisory Council discuss changes to the program related to the community stability scoring criteria, and specifically the program's sustainable or green building standards scoring component, Hilary Lopez, our moderator, suggested that the community investment team reach out to the Nevada Housing Division to discuss sustainable building components and techniques contained in the Nevada qualified allocation plan. And the idea behind the suggestion was to see if there was room for better alignment of standards between the 2 programs. Part of that collaboration and dialogue involves educating each other on how each entity arrived at their specific standards. And currently, the Nevada QAP contains more of an extensive assortment of components where an applicant's project can receive different points for certain items, but there are no clear levels. And there are many great elements included, but it is hard for the bank to consistently conclude that a project has met a certain standard or certification level, as in LEED or Green Point rating tiers that the bank uses. So a lot of work has been performed by the Nevada Housing Division, some of which stems from the bank request for a comparison of how current QAP standards are comparable to the certification levels for which the bank currently awards points. So in conclusion, I'm pleased to report that the bank CID and Nevada Housing Division have been collaborating and are attempting to work towards some alignment, and we hope to have some positive information, positive news to everybody in the near future. So that's all I have to say. Stay tuned for that. And the next slide. So thank you.
Thank you, Erica. We're excited. As you mentioned, I think some of the scoring changes will really help some projects in Nevada that maybe weren't as competitive through the process in the past, and then definitely excited to hear about the continued discussions between the division and bank. And then just to kind of keep going, our final speaker is Claudia Hansen, who's the planning manager for the city of Reno. Claudia currently manages special projects out of the office of the city manager, including updating the Parks and Recreation Master Plan, overseeing historic preservation, administering some capital improvement projects, and updating the Reno Municipal Code to recognize critical needs such as the implementation of SB 103, which was also passed in the last legislative session. And we're excited to hear about its implementation. And with that, I'll turn it over to Claudia.
Great, thank you. Okay, I'm going with everybody can hear me. Okay, first you can go to the next slide, since I just realized that the date was wrong on my title slide, so go through that one quickly. So the background on SB 103, as Hilary mentioned, it was passed in the last session. And in a nutshell, SB 103 enables cities to subsidize, either in part or in whole, impact fees or fees that support enterprise funds. So at the city of Reno, that includes building permit fees and sewer hookup fees. And that's just the hookup portion. That's not the monthly bills going forward. So just when the project's being built. Ultimately, it'll also be able to be used for the RIF, so the Regional Road Impact Fee, but that also involves Washoe County and City of Sparks. So that's going to take a little bit more regional collaboration. That we are already meeting with RTC to get that going, but to date, the City of Reno is the only entity that has adopted an ordinance enacting SB 103, which is a requirement of the bill. Okay, next slide. Okay, so how council acted on this, they immediately recognized the importance of this this measure and initiated an amendment in November of 2019. And at that point, directed staff, in particular, to work with stakeholders to draft an ordinance that's going to work for our community specifically. And with that, we had a roundtable discussion also in November of 2019. So I think the main point on this is how quickly the city moved on this. City council directed us to work on this very quickly and get this adopted so it was available for the developers. So we drafted the ordinance with the input from the roundtable group, and ultimately the city adopted the ordinance in February of 2020. So if anybody has ever waited for an ordinance for a city to adopt, we got it done in less than 4 months, which is lightning speed for a lot of jurisdictions. All right, next slide. Okay, so what came out of that ordinance? It's required by state law that there is a public hearing for every application. So if a project wants to come in and request the subsidy, the application comes in, ultimately it does have to have a public hearing for council to consider the impact on the funds. So as we all know, city budgets change year to year. Last year is very different from this year. It's going to be very different from 5 years from now, and nobody can tell where we're going to be. So it does require a public hearing when the applications come in, so that city council has the opportunity to say yay or nay and weigh the impact it's going to have on our funds. So the state law also required that we adopt some criteria within our ordinance. So the roundtable group came up with 3 criteria. The first, if a project comes in with an average 60% AMI, they are eligible to request a 75% reduction just for the units that are at or below 60% AMI. And they can request an additional 10% if they're near a BRT, bus rapid transit. So they can request up to an 85% reduction in the fees. And again, that's building permit or sewer hookup. If the project is an average of 50% or less AMI, 100% reduction for the units that are at or below 60% AMI. And if the project averages at 30% AMI or all of the units are below 50%, then they are eligible to request 100% reduction for all units. So on a small project, that can be $10,000 to $20,000. But for the larger units, for the larger projects, if there are 200 units at that can be hundreds of thousands of dollars in savings from city fees. And the city doesn't have a whole lot that we can offer. This is one thing that we actually have the ability to offer. Okay, next slide. Okay, so moving forward, we do have the applications available. They are on the city website already. The application will come in. We have staff available to meet with those that are interested in it. We can sit down and help you with an analysis. We'll bring people together from finance, public works on the sewer impact fees, or I'm sorry, the sewer hookup fees, and then the Community Development Department, as well as the Housing Division, which is where it would initially start. So we can give anybody interested in it a preview of what the review is going to look like, what our budget is looking like at that point in that year. The staff will make a recommendation and analysis of the finances for the city on that and make a recommendation to City Council. At this point, we have received inquiries on this, but no applications have been received at this time, although I am told that somebody will be applying in the near future or looking into it in the near future. Hilary might have more on that for us, but that is, I'm told it's up and coming. So we're excited for somebody to use this tool that we have available. I think that's all of my slides. I know we're running late, so I try to fly through it a little bit because I know we're 4 minutes away from 4 o'clock. So there we go. That's our SB 103 enactment into Reno Municipal Code.
Thank you, Claudia. And yes, as Claudia mentioned, even though the city hasn't received any applications yet, we are working with several developers that are anticipating using the fee waiver. It does make, as you said, a big difference, both for smaller projects as well as larger projects. Every tool that we have available to us kind of helps make these projects work, keeps it viable, and we're really appreciative of having this tool available and how quickly the city implemented the ordinance. So we appreciate that. With that, I know we only have a few minutes left. I want to thank everyone on the panel. It was a ton of great information. Also, there's been some responses to different questions in the chat. And Carol Wayman from Senator Catherine Cortez Masto's office has also posted some information in the chat regarding the Federal Home Loan Bank's investments in Nevada and some other links to Federal Home Loan Bank documents. And then I know that we've had a couple of other questions that have come up. I think the majority of them have been answered through the chat. I'm just kind of scrolling through and taking a look. If you haven't had a chance to look through the chat, there were some questions regarding where the funding comes from for the state tax credits and then the pricing that's anticipated for them. I know, Michael, that you did put some information in the chat. David, I don't know if you have any additional information that you could share on that.
I will hold off on sharing the pricing, as I would like to ink the drive before before I do that.
And then I think that there was just some other questions, as mentioned, about demand for the affordable housing program funding over the last few years. And Eric, I don't know if you have any information, quick information on that question.
Generally 4 to 1 in terms of, 4 to 1 ratio. I don't have the historical data on that. I'm trying to look up some information. So I didn't have a calculator in front of me here, but there was about what did I say, $121 million requested and about 37 given out last round. That gives you an idea just on the numbers. Sorry for not providing the ratios. Maybe someone else on the panel, the first 2 presenters, probably be able to do a better job of that than me. It's a huge request, right? We have a huge demand always, and we're oversubscribed.
And I think, you know, that's the same for all of these programs that have been talked about today, the tax credit program. We're hoping that we'll continue to see increased demand and supply in the state transferable tax credit. But all of the tools that we could create and use are helpful and appreciated, and we look forward to continuing to work with all of our partners on moving more and more projects forward. So it looks like we have run out of time. Christine, I don't know if you wanted to put up the final polling question.
We're good. I'm pretty sure everyone would give this session 5 stars though. So I'd love to see everybody hit 5 stars because the speakers for me were fantastic. Thank you all. And Hilary, thank you.
Yes, thank you all for participating. We greatly appreciate it, and have a great rest of your day.
Thank you.
Thank you.